So my name is Glenn Grant, and I'm an entrepreneur just like you. So my backstory, I started my business in 2009 called G2 Tech Group. It was a managed IT consulting firm. In 2012, I pivoted my business to manage cloud and manage DevOps to be a little bit more differentiated in the marketplace. In 2017, I decided it was time to start making a move. I saw the market conditions were right for me, so I started the process of selling my business. In 2018, I sold my business to Great Hill Partners, which is a private equity firm here in Boston, Massachusetts. And in 2020, I became a business coach and a certified value builder because I found it to be really fun and exciting to work with other entrepreneurs, especially those that are trying to grow and sell their business. So when I sold my business, this was my team. So these are the other panelists here today, and I can personally vouch for all of them. They're fantastic people. They're awesome what they do. And I'm not just saying that, I experienced it firsthand. Additionally, they're all entrepreneurs and business owners. So they get it. You know, they're just like you as well. So they understand what it's like to own and operate a business. And again, I can vouch for them. They're the real deal. So Calvin, I was already working with Calvin. I was very fortunate to be working with his company, SmartBooks. When I decided to sell, he immediately started to help me get my ducks in a row. And I didn't know what ducks I needed to get in a row or when to start doing that. SmartBooks was already providing fractional CFO support, bookkeeping, and accounting services. So he got me rolling. Matt Rudnick, he helped me navigate the process of selling. So that kept me from falling into an early proprietary deal. Some of you may have been approached by people already. They try to reel you in before you really take your business to market. So Matt came in and saved me there. And then he helped me market my business and find more than one offer and then manage the process, which to me was the most important because it's a delicate dance. And I definitely needed an intermediary. That's just my style. And then we have Melinda Davis. Mindy helped me and my family prepare for the closing and what to do with the proceeds. I never had a portfolio to speak of or anything like that. My entire net worth was wrapped up in my business, right? I made money, paid the bills, but kept putting it back in to grow and fund future growth. So Mindy helped us set up the right structure in advance so that at closing, the funds flowed somewhere intelligent and they didn't just go to my Bank of America checking account because that's where they would have gone had I not met Mindy. Anyway, they're all great people and have become wonderful friends. And now that I'm coaching other entrepreneurs, I wanted to bring them together and make sure that I introduce them to as many people as possible that might be in the same position. So the big questions for today, are you ready? Is your business ready? What's your freedom point? Do you know at what point what your number is? And then when it's a good time to make an exit? How do you get there? And then, of course, how do you actually complete a transaction? And if you've never sold business, you've never gone down that road. So there's different nuances to that. And Matt's going to talk about a little bit of those. All right, so we'll get going. We'll start with our first polling question. All right, so first poll is out here. On what timeline are you considering selling your business? This will give me an idea of where everybody's head is at, because if it's right around the corner or it's way out into the future, that can really make a big difference. I'm glad right now nobody's taking this business to the grave with them. It's not a good idea. Well, I mean, it might be a good idea for your family, but you won't be able to enjoy the benefits of having sold your business and seeing the dream come true. So let's see, 91% of you had voted. Just give it one more second here. All right. So let's see here. All right. I would say the majority of folks are looking at 3 to 5 years out, which is good, a good, healthy timeline. The next 2 years as well. And then some of us are a little bit more aggressive, less than a year and in a year. Some of us are looking way out. Some of us haven't really thought about it. All right. Well, let's get rolling. If you have the workbook open, turn to page 1. All right, so let's dig into you. So in the workbook, I have a little section here. You can kind of rate yourself on a scale of 1 to 10 to just kind of get a feel where you think you might be in these areas. So what makes an individual ready to sell their business? Well, we've boiled it down to these four key drivers that lead to a personally satisfying exit. So first thing is future vision. Why do you want to exit your business? What do you plan to do after you leave your business? You know, are you going to retire? You're going to start a new business? Are you going to consult? You know, how done are you? Are you completely done, maybe halfway done, or not done at all? So depending on where you are, you may choose different paths. Many owners decide to sell because they need to retire, take care of their health, and that's an extremely valid reason to exit, but is not always necessarily leads to a satisfying exit. To maximize your score in this area, you want to become clear on what you're excited to do after you leave your business. A lot of us don't really think about it until we've already done it. And I've heard some stories of people being really bummed out and they didn't have anything lined up next and they just felt empty because very attached to the business. The next one is structuring flexibility. So have you considered the practical financial questions surrounding your exit? How much is your business worth to you? And what's your bottom line when you go to sell your business? These can be two very different things. How much of that money are you willing to receive over time or put at risk for a potentially bigger return on exiting your business? And are you willing to entertain an earnout scenario, or are you only looking for an all cash deal? So if so, how much are you willing to risk? And for how long are you willing to work in the business after you've sold it and you are no longer the boss, right? So an earnout scenario where you're getting paid after the fact for hitting milestones can be challenging for an entrepreneur who hasn't had a boss. So the key to maximizing your score on this driver is to remain flexible on how your deal is structured. Now, I am the anti-earnout guy. I try to work with my clients to avoid an earnout at all possible, if at all possible. However, that makes things more difficult for folks like Matt that are trying to find you a number of different buyers. So I swore to Matt that I would say remain flexible, but I think you all know where my allegiances lie. The next driver is personal attachment. How personally attached are you to your business? You know, is your business your baby? I think a lot of us have been there. You know, have you built a fulfilling life outside of your company? How much of your own self-worth is tied up with your role as the owner? You know, when you're at a cocktail party, do you say you own a business or you're a business owner, right? So it's natural to be proud of your business. I was very proud of mine, but being too personally invested in your company can lead to a difficult time transitioning it. I didn't have that problem. I was ready to sell my baby to the highest bidder. But you know, not everybody's in that same spot. The secret to maximizing your score in this attribute is to start building up a rewarding life with friends and family and fulfilling projects outside of your business. And if you're working in your business a tremendous amount, that can be difficult. And we'll talk about trying to unwind that a little bit as well. The next one is team involvement. Have you considered how your employees will be treated when you exit your company? So for every employee you tell about your plans to exit, the chances that the exit will collapse grow exponentially. So we all have employees. Employees are wonderful. We love them all, but they can do irrational things from time to time. I'm sure we've all been there. So customers may leave, suppliers might get spooked, employees might start looking for other jobs, even though there's no reason for any of that to happen. So despite the considerable risk of being transparent about your exit plans, some owners feel the need to tell select employees before the deal is consummated. In my situation, I actually had all of my employees were on board with what was going on, but I had structured my company from the beginning in that way. Certainly, if somebody had asked me, would I do that again that way? I might tell them probably not. Do I think I would do it the same way? Yes, I probably will. So to maximize your performance on this attribute, consider the people on your team. Is there anyone you need to or want to involve from the beginning? And typically you're going to have some senior people that are going to need to be part of the process. So you're going to have to tell somebody. All right. So moving on to your business. Is your business ready? So when I'm coaching my clients, I focus on these three areas at a very high level. The first one is entrepreneurship 101. You probably all know about this. I'm not going to teach you anything new. You need to bring in more revenue than you pay out in expenses. Increase revenue and profitability. Get your numbers up. If you're still here with a business, you've figured this out, or you're fighting a good fight. The point here, though, is that a buyer is really buying your future stream of profits. That is what their interest is in. So we want to get your profits up. That one's pretty straightforward. The next one is the business is running itself. And this is important for more than one reason. The first one being, if we can get the business to run itself now while you own it, you get personal freedom, right? You could work to a point where you actually are kind of on the job retired. You are just an owner. You own this asset that helps create wealth for you, but you're not working 80 hours a week in a business. When we're talking about an exit, this is where it's really important to have the business running itself to avoid an earnout scenario. Again, if you're a self-employed entrepreneur for a number of years or decades, and now you work for somebody, and that somebody now gets to call the shots on what happens in the business, and a big part of your proceeds from selling the business is tied for you to you being able to hit certain milestones, you might not be in charge or a position to be in charge of how those milestones are actually going to be accomplished, and that can be very, very stressful. The last area is getting the highest multiple possible on exit. So increasing the sale price of your business when you go to sell it, and also playing defense, avoiding the discounting of your business as people start to do the diligence process. You want to get the most you can for all the blood, sweat, and tears you've put into your business. So the multiple. So I came from the IT world where acronyms and jargon are a way of life, and it drives me nuts. But I've never been afraid to ask, what does this mean? And normally it's actually not a big deal, but you feel embarrassed. But anyway, so I've always asked what it means. Now I'm on a mission to decode all the M&A jargon I can for you, starting with M&A. So M&A stands for mergers and acquisitions. And in a nutshell, that's the business of buying and selling businesses. My colleague Matt here is an M&A advisor. He's in the industry. He's also been a great Sherpa for me when I went on my journey, because there's a lot of nuances to the industry. The next piece of jargon I will explain is called the multiple. So it's also referred to as the transaction multiple, the valuation multiple, and the acquisition multiple. In the M&A world, a multiple is used to value a particular kind of company based on recent trends. So buyers tend to start with a multiple that is close to the one that was used in a recent sale of a business that looks like yours. And then they make adjustments to that multiple as they dive deeper into the specifics of your company. So it's actually not that complicated once you understand what the jargon is. Essentially, there's a number of dollars. It's usually profit or EBITDA. Sometimes it can be in revenue or sales if you're very fortunate, or you're in a growing tech industry or something where you're growing, but you've never actually profited a dollar. They would use multiple of sales. Then there's the multiple, which is a number. Multiple times the dollars equals the value or sale price of your business. So for an example that's easy here, if we had 800K of EBITDA, the industry standard average multiple is about 3.5 times EBITDA for a financial buyer. And you would have $2.8 million of value, and hopefully that is your sale price. I must reinforce, however, your business is only worth what somebody is willing to pay for, right? So your business on paper could be worth $2.8 million, but until somebody puts that money in your hands, it is not worth $2.8 million. And when they go through the process of evaluating your business and the diligence process to see if they want to go through with it, typically it's the multiple that gets manipulated, because the numbers are the numbers when it comes to EBITDA. Maybe there's some discrepancy there related to add backs, but at the end of the day, when they're looking at it holistically, It's the multiple that's going to get manipulated. So just a quick example of different multiples for different industries. The average is 3.5. Different industries trade at different multiples depending on how comfortable the buyers are with the future stream of profits, and that stream is going to continue to flow. One number that's not on this chart right now is US software companies are actually trading at around 19 times EBITDA right now, which is pretty crazy, and why I didn't put on my graph, because my graph would look funny. But I tell you, if and when I do start another company outside of executive business coaching, it will definitely be a software company, because the multiples are higher and you need less employees, and that makes for a happy entrepreneur, in my opinion. So most owners only focus on increasing profits, and I was one of those owners. So when I started working with Matt, I was like, okay, I think the market's ready. They want to buy my types of companies. I better get my EBITDA up, because I had been reinvesting in my company's growth. So if I buckle down and get my EBITDA up, you can see from this example, we bring up net profit or EBITDA by $100,000, multiply it times that same standard multiple of 3.5, we've increased the value of the business by $350,000. So smart owners, I learned, also focus on getting the multiple up, or defending the multiple from being discounted. So same formula here, 800,000 times 3.5 is 2.8 million. However, if we don't get EBITDA up, but we're able to get our multiple up, you can see the value has now jumped by $1.2 million instead of $350,000. So it's important to pay attention to both of these numbers, because certainly if you can get profitability, and revenue up, it's going to help you. But at the same time, working on core elements of your business to get that multiple up as much as you can. Now, again, different businesses trade at different multiples. You're not going to be able to get your multiple to be 19x if you're not in the software business with just effort. But you certainly can increase that multiple to some degree in just about any business. So what do buyers look for when we're talking about determining the multiple? So if you are following along at home in the workbook, I assume at home, because a lot of us are at home. I'm at home. But if you're following in the workbook, turn to page 3. And again, sort of rank yourself on a scale of 1 to 10, just to see, at the end of this talk, how you're feeling about where you are in all these areas. So in my coaching practice, using the value builder system, we've broken it down to 8 key areas that drive business value. And now this is through the lens of a potential acquirer, and I experienced this firsthand, so I know it to be true. So the first one is financial performance. We already talked about that. Entrepreneurship 101. Not going to go into that too much more. Get your numbers up, make more money. It'll be a better situation for everybody. The next one is growth potential. Okay. So again, a buyer is buying your future stream of profits. And when they buy your company, typically it's because they think they can do a better job growing your company than you can. Especially when we're talking about somebody who's in like private equity or some sort of growth capital situation. They want to know that there's a place to grow the business. They want to know that the market hasn't been tapped out. If you dominate your entire market, there's nowhere for them to take that market to increase the size of the business, and there's not a lot of upside for them. They don't want to just maintain a business. They want to grow a business. So they want to know that you can sell more products and services to your existing customers, and they want to know that you can sell these products and services to more markets. So to the extent that you can prepare yourself in the next 2 to 3 years before you sell your business by dipping your toe into these different markets or looking at different products and services to sell to your existing customers, even if you don't get a lot of traction right out of the gate, that is something that's going to be attractive to a buyer. The next one is the Switzerland structure. So this is not being overly reliant on any single customer, employee, or vendor. So when it comes to customers, you might hear diversification of revenue. That is one of the pieces of M&A jargon. If you have a client that, totals 50% of your revenue, and that client decides to go away after you sell your business, that's a major risk for a buyer. So we don't want to be too reliant on a single customer. We don't want to be too reliant on a single vendor. So in my case, I was in the cloud space and I was very reliant on Amazon Web Services. However, I could also use Google or Microsoft if need be. So you want to avoid being in a situation where there's just one vendor that can kind of hold you hostage, especially if you end up selling to that vendor, because then, they kind of beat you up on price. That does happen. And then, of course, there's the employee factor. So if you have a unicorn in your business, I know I had one. A buyer doesn't want to see that either, because that unicorn could decide they were, there for you, and after you sold the business, they left, and that could put the business in jeopardy. So it's not a bad thing to have that situation. A way to remedy that is put incentive plans in place for that employee, whether it be, phantom stocks or a sell bonus or something that's going to retain that employee to the sale and through the sale for a certain period of time, to make that buyer feel comfortable that they've got some runway to work with, either to maintain that relationship longer or find an alternative solution. The next driver is the valuation teeter-totter, and this is really about cash flow. Does your business have the ability to generate a pile of cash in your bank account that you can use to fund growth and future endeavors? Or are you often getting paid in the rears, forcing you to dip into a line of credit to cover your expenses and your payroll while you're waiting to get paid? So to the extent that you can get paid up front or paid along as you go, as opposed to getting paid in the rears, that is going to make your company more attractive. And this can be a big challenge if you work with the public sector a lot. State governments and municipalities, they don't move very fast, and that can be a challenge. So working on trying to make sure that you're getting paid as quickly as possible, so that you don't have to extend your credit as far as you would otherwise. The next one is reoccurring revenue. So again, future stream of profits. How much reoccurring revenue do you have? What's the total percentage of reoccurring revenue? And what kind of reoccurring revenue is it? So to the extent that we can have business keep coming in the door, whether it's a monthly service charge or auto renewing contracts or what have you, reoccurring revenue is very attractive to a buyer, as opposed to project revenue or one-time engagements with customers, where you have to continually go to that customer and resell them and over again. So what can you do to add reoccurring revenue to your business if it's not there? And even 10%, 20% of your revenue is better than nothing. So are there little things that you can add onto your offering that will create a stream of reoccurring revenue and add some stickiness to the client relationship? The next driver we call monopoly control. And this is about being in a differentiated position in your market and not being commoditized. So one of my favorite books on this topic is called Blue Ocean Strategy. It was what prompted me to pivot my business from managed IT to managed cloud. I'm sure business owners here on the webinar today have experienced IT companies like mine calling them up all the time, trying to become their help desk and their whatnot. I faced that competitive pressure all the time until I sort of repositioned myself in the market to a blue ocean where I didn't have as much pressure there. And then a buyer looks at that for two ways. One, the competition. Two is when you are differentiated, you have the ability to set prices. You've taken an apples to apples situation and created an apples to oranges comparison. And you have a lot more leverage to set the prices for your offering, because you're not competing against 3, 4, 5 other vendors, all trying to woo the same client to signing up with them. The next piece is customer satisfaction. So the gold standard in customer satisfaction right now is the Net Promoter Score. And when I sold my business, the buyer actually interviewed all of my customers. My situation was in a place where that was okay. I said, go ahead, tell them we're trying to raise some growth capital. And the relationship I had with my customers, that was a okay thing. They wanted us to grow and have more resources. So a buyer will check with all of your customers if they're sophisticated. And they want to know that the customers are going to stay to protect that future stream of profits. And also on the sales side, referrals are some of the best sources of new business. So if you've got a lot of customers and they're all really, really happy, that's going to make a buyer feel much more comfortable. And last but not least, my favorite is the hub and spoke driver, which is the business owner the center of the universe? Is the business owner's name on the building? Do they know every single client and every client wants to talk to them first? Are they the one doing all the sales? Are they the one who's really the keeper of the kingdom when it comes to operations and service delivery? A buyer is buying a future stream of profits. And if the world revolves around you, well, then they're going to buy you, which means you're going to be locked up in an earnout for at least 3 years. And to get most or sometimes all of your money, you're going to have to help that buyer continue to run that business for a certain period of time and hit those milestones. So this is one that I work on very deeply with my clients. I also do, leadership team facilitation. So building a leadership team, empowering a leadership team, getting the business to run itself. And while you own the company, you can take a step back and do more fishing or golfing or whatever it is that, makes you happy, and start to work on that life after the business. And then when you get to that point where you're actually selling the business, you're also not as important in the bigger equation. And hopefully that will mean less of an earnout scenario for you. So wrapping up here on my talk, focus not only on, is your business ready to be sold, but also on yourself. Are you ready? Develop a personal exit strategy. Think about the things that are going to happen in your life when you don't have that same job that you've been working on for X amount of years. And then also, what are the things you can do to your business now while you're starting the process or in the process to turn those dials to get your multiple higher, or make sure that it's a defensible multiple that people are not going to discount the price of your company when they go to buy it. So we use 2 tools in my coaching system. One is called the pre-score. There's a link here on the screen. You can check it out. It's similar to the workbook, but more in depth. And then also the value builder assessment, where we score you more deeply on those 8 key drivers. And then we're essentially going through a program to help you figure out ways to get those drivers, the numbers up on those different drivers, and keep your multiple at a high spot or increase it. So with that, I will jump into Q&A here. I did see a few questions come in. Oh, a question has been answered. That was about the workbook. So are there any more questions for me?